Hi everybody, this is James Tompkins and welcome to Lecture 5 of the Advanced Corporate Finance series. And this is actually the final theory lecture of capital structure. And so what I'd like to do is I'd like to begin with reviewing what we've done so far in the capital structure lectures. So first of all, we began with perfect market assumptions. And we assumed that the asset investment decision was fixed. In other words, hey, you know what? No matter how I choose to raise money for my lemonade stand, I'm still going to invest in my lemonade stand. So that's the asset investment decision. And what were the perfect market assumptions? Do you remember? Well, basically, no taxes, no transaction costs, which included financial distress and bankruptcy costs as an example. No information asymmetries. So for example, that means I would know as much about IBM as the CEO of IBM. So by the way, those are all realistic or unrealistic examples. Well, those are all unrealistic assumptions, I should say, right? I mean, of course we have taxes, and of course we have information asymmetries, and of course there are transaction costs. But what we did was we said, well, how important is the capital structure decision in a world which actually doesn't exist, and why do we bother with that? Why bother seeing how the world worked in a world that clearly doesn't exist, in a world that clearly has taxes, for example? Well, our approach has been to see, well, how does the world work, or what is the importance or lack of importance of the capital structure decision in this unrealistic world, just to keep it simple, and then we started adding in things like taxes and things, and see how things changed. In any case, Miller Modigliani, under the assumption of, hey, no matter what, I'm going to invest in my lemonade stand, and we're in a world of no taxes and no transaction costs and no information asymmetries, what did they say about total firm value? Was that affected or unaffected by capital structure decision? It was unaffected, right? And what about the stock price? This was their second proposition. Was the capital structure decision important or unimportant? It was unimportant. So basically, in that very simple but unrealistic world, the outcome was, hey, capital structure does or does not matter. Does not matter. So then we said, all right, well, let's throw in taxes. And we began by throwing in corporate taxes. And we found that the benefits of debt, or the gains of leverage, was essentially this corporate tax shield here, which we derived as the marginal corporate tax rate times the sum, the total value of debt. And so under that scenario, if you wanted to maximize the value of the firm, would you have a lot of debt or little debt? You'd have a lot, right? I mean, let me just remind you, okay? What we said is we said, well, you can think of the value of the firm that's levered, or one with debt, as the value without any benefits of debt. So we called that value unlevered, plus any gains or leverage that existed. Okay, so the total value of the firm you could think of as its value without any, if you will, benefits of debt, like the debt tax shield, plus any gains that might exist. And when we talked about corporate taxes, well, the gains of leverage was the debt tax shield. So if in that situation the gains of leverage is the corporate tax shield, then to maximize this guy, the value of the firm, you'd want a lot of debt or just a little debt. You'd want 100% debt, right? And which is clearly ridiculous. But in any case, under that scenario, the capital structure decision was or was not important. It was important, right? But then we thought, all right, well, that doesn't make a lot of sense, right? Because if taxes were what drove the capital structure decision, then a company like IBM would say, you know what, we should have a lot more debt, because right now IBM has a very risky or very safe debt rating. They have a very safe debt rating, right? Maybe it's AAA or something like that. What that means is that, are they giving up a lot of debt tax shield? In other words, could they afford to have a lot more debt if they wanted to? They could, right? But do we see them doing that? We don't, right? So there must be more of the story than clearly this corporate debt tax shield. So then we added in what Miller had to say. Miller said, hey, you know what? Investors care about before tax returns or after tax returns? Well, you and I, if we invest in something, in the end, do we care about what we get, or do we care about what the government gets? Well, probably about what we get, right? In other words, after all tax returns. And so Miller went through this model that basically argued that, hey, you know what? Firms will issue debt in the aggregate until at some point there's no more after tax, or there's no more tax benefit in having debt versus having equity. Because what we saw was that when it came to debt, was the tax treatment happy face or sad face at the corporate level? It was happy face, right? Because when it came to debt, interest is tax deductible at the corporate level. But what about at the personal level? Who had the happy face now? Stockholders, right? Because basically, if nothing else, they could defer taxes by not selling the stock for a really long time, and so avoiding a capital gains tax. And historically, dividends have been taxed at lower than ordinary interest income. And so basically, according to Miller, once you add in personal taxes, his model was in equilibrium. Hey, we're back to capital structure not mattering. In other words, with Miller, this GL got back to zero. Now, that doesn't make a lot of sense either, because if GL is zero, then for a company like IBM that expects to receive the debt tax shield, and to say for them the benefits of leverage is zero, then if we look at a company like Borders, which eventually went bankrupt, so if we look at the days when they were struggling, and clearly when they were struggling and losing money, would they realize or not realize the debt tax shield? They wouldn't, right? So if the value of leverage for a company like IBM is zero, then for Borders it would be negative. And so if having a certain amount of debt for Borders has negative value, so in other words, when Borders borrows money, that creates negative value, well, that would suggest hey, let's just flip it if we're Borders. Well, instead of borrowing money, we'll lend money, and that'll create positive value. In other words, we'll maybe issue equity and we'll turn out and we'll lend it. And do we see that happening? We don't, right? And so that's also sort of a ridiculous thought process. And so in the end, when it came to taxes, what we said was, well, maybe a middle-of-the-road point of view is that a company like, say, IBM, that expects to fully realize any debt tax shield it has, maybe there's a modest advantage from a capital structure perspective. And maybe for Borders, back when they were still alive, maybe there was a modest disadvantage, okay? Either way, does it look like taxes are the primary drivers behind a firm's decision on how it's going to issue capital, or rather how it's going to structure its capital? So, no debt versus all equity, or 50% debt, 50% equity. Does it look like taxes are the driving force behind that decision? It doesn't, right? And so what that means is there must be more to the story than what we get out of taxes. So that's a quick summary of the previous two lectures in capital structure. And if that was just too much for you, I'd strongly encourage you to go back and begin with the first lecture in capital structure. And so today we're going to continue to remove those assumptions. So if I give you an agenda, we'll start off by looking at transaction costs, because remember, one of the perfect market assumptions was what? No transaction costs. And bankruptcy is a type of transaction cost. So we'll look at the role that firms think about, or we'll see if firms cognitively think about bankruptcy costs when they're making their capital structure choices. And then we'll look at another assumption that we made. And if you recall, we said, well, hey, you know what? No matter how I structure my capital, whether it's no debt and all equity or 50% debt and 50% equity, no matter how I structure it, I am still going to invest in my lemonade stand. In other words, the asset investment policy was fixed. Well, what if it's not true? What if how we structured our capital does have an impact on whether or not I invest in my lemonade stand? Or how Boeing structured its capital does have an impact on whether it chooses to develop the 787 or develop a new future aircraft. What if that were the case? Okay, and in particular, we'll look at financial distress, which is also a type of transaction costs, and later on I'll distinguish between what I mean by bankruptcy costs and financial distress. We'll also see that this concept of free cash flow is related to how a firm structures its capital and the asset investment decision. Then we'll look at another perfect market assumption, information asymmetry. And they're going to be two topics that are relevant to information asymmetry as it pertains to capital structure. One is signaling, one is pecking order theory. Of course, I'll get into that when we get there, tell you what I mean by that. And then finally, we'll look at some other capital structure issues. What about long-term debt versus short-term debt? What about private versus public debt? And then finally, I'll summarize everything and I'll bring in some interaction that we had. I don't want to name their name online, but we'll bring in some interaction that we had with the treasurer of a Fortune 100 company as it related to how they tackled capital structure, or from a big picture perspective, if you will. So I'll begin with bankruptcy. Okay, what is the role of bankruptcy as it relates to the capital structure decision? So an agenda for this is we'll discuss, what is bankruptcy, and then we'll look at bankruptcy costs themselves. So what is bankruptcy? What do you think of when you think of a firm going bankrupt? Well, basically, bankruptcy is a process. Okay, what's the process? Well, a process is a systematic series of actions with a goal or an outcome, a desired outcome in the end. Okay, and basically, when a company owes interest on debt and it doesn't pay that interest, or it only partially pays it, or whatever, then the debt holders can force the firm into Chapter 11. Now, when the debt holders force the firm into Chapter 11, does that mean the company has to stop doing business? It doesn't, right? So, for example, Kmart. Kmart went through Chapter 11 a number of years ago, but you still went shopping at Kmart. And so what's going on with the bankruptcy process while people are still shopping at Kmart? Well, basically, bankruptcy is the process of figuring out how much a company is worth and then allocating its value to those who have a claim on its value accordingly. So the question is, well, if that's what they're going through, then why not just split up the firm, sell off the Kmart stores and so on and so forth? Why are they allowed to keep doing business? Well, what if Kmart is worth more as an ongoing concern than it would be if you just sold off all the stores? Then would the bondholders want you to go through that process so they could get more cents on the dollar for the money that's owed to them? They would, right? So in the bankruptcy process, while the judges and lawyers and the various parties, when they're figuring out what the company is worth, one of the things they're looking at is, well, what is it worth as an ongoing concern versus what is it worth liquidated? Now, if it's worth more liquidated, Then the firm goes into Chapter 7, and in this example, Kmart would close its stores and nobody would shop there anymore and everything would be split off. But to give you another maybe good example, what about Disney? Okay, what if Disney went bankrupt? Do you think they'd just sell off all the individual parts? Probably not, right? Because Disney's name has a lot of value, which means it probably has a lot more value as an ongoing concern than it does as just selling off the various theme parks and so on and so forth. So basically, to summarize, bankruptcy is a process. It is a process of figuring out how much a company is worth, determining what its value is, and then allocating that value to the various parties that have a claim on that value. So let's look at bankruptcy costs. What are some examples of bankruptcy costs? Can you think of any? Well, what about legal fees? Would that be a bankruptcy cost? Sure, right? I mean, there's going to be lawyers involved and judges involved, and they need to get paid, and et cetera, et cetera. Can you think of any other examples? Well, what would you like, in a perfect world, what would you like management to be focusing on? Well, presumably you'd like them to be focusing on, running the company and the strategic direction of the firm and so on and so forth, right? But if a company is involved in bankruptcy, is some of their time going to be diverted? I mean, it could be a little, it could be a major portion, but is there going to be a diversion of management's time? There is, right? And because that time is being diverted due to bankruptcy or going through the process of bankruptcy, would that be a type of bankruptcy cost? Sure. Can you think of any others? Maybe some of you have worked for a company where there were rumors of it going bankrupt, or maybe it's in trouble and there are rumors of it being sold. And what would you personally do? So imagine you're with a company and it's on the verge of bankruptcy. Would you feel pretty secure about keeping your job? Probably not, right? And so in the meantime, might you be looking for another job? You might, right? So when a company is going through bankruptcy, even if that company reemerged in the end as an ongoing concern, like for example Delta Airlines went through bankruptcy and now they're flying again, okay? But is it possible that employees might leave in the meantime? They might, right? And to the extent that happened because of bankruptcy, that would be a type of bankruptcy cost. So basically, bankruptcy costs, it can be direct. For example, legal fees, that'd be direct, but it could also be indirect. Okay? For example, diversion of management time. Either way, a bankruptcy cost is any cost that is incurred by the firm because it's going through the bankruptcy process. So let's talk a little bit more about bankruptcy costs. And do you think they vary depending upon the type of firm a company is? And let me talk first about maybe firm type to be more specific about that question. Okay. Now I know that we're used to thinking of the value of the firm as the sum of the market value of what? Of its debt and equity, right? I mean, if I draw a quick diagram here, okay, we're used to thinking of the value of the firm as the sum of its debt and equity. So if the market value of debt is 40 and if equity is 60, then the value of the firm is 100, right? But conceptually, you could also think of the value of the firm as the value of assets in place, so tangible assets, so maybe buildings it owns and so on and so forth, plus the present value of all future growth opportunities. Okay? So for example, what would be an example of a firm whose value is primarily in the value of the tangible assets? Well, maybe a railroad company or maybe a hotel or something like that, right? What about one whose value is primarily dependent upon, all future, the present value of all future contracts and that they're going to be getting? Well, what about a consulting firm? I mean, if we think of, maybe a famous consulting firm like McKinsey & Company, do you think the value of McKinsey primarily lies in the buildings they happen to occupy, which they may or may not own? Who knows? Okay, or do you think the value is primarily in all the future expected income they're going to receive because of their consulting expertise? Probably the latter, right? And so when we think of a firm whose value is primarily either lies in tangible assets or present value of all future growth opportunities, which one do you think would have higher bankruptcy costs? Now remember that bankruptcy is a process, right? A process of doing what? Well, the process of figuring out value and then allocating that value to the various parties that are entitled to it. So the first thing is to figure out a firm's value, right? Well, how would you, suppose a hotel goes bankrupt, how would you figure out the value of a hotel? Well, you could put it on the market, right? If you put it on the market, whatever it's sold for, would that be its value? It would, right? Is that a fairly simple process? Sure. If it's a relatively simple process, is it more costly or less costly? Less costly, right? But what about a consulting firm? Okay, so here you have a consulting firm. It's on the verge of bankruptcy, and we're trying to figure out its value, and people are leaving, and you don't know who's going to be staying, and you don't know the impact of going through the bankruptcy has on the reputation of the firm, and so there's a lot of uncertainty about future contracts, etc. Is that value going to be, say, relative to the hotel, easy or tough to figure out? Tough, right? I mean, you could almost argue it's a moving target as key employees are leaving. And so therefore, with that much more complex process in figuring out the value of a consulting firm, would it have higher or lower bankruptcy costs? Higher, right? And so basically, one whose value is primarily dependent upon the present value of all future growth opportunities, that's going to have higher bankruptcy costs. So it's a lot less complex to value and transfer value of something tangible like, say, a hotel than something whose value is primarily based on intangibles. A study that was done a long time ago, for example, was when Warner Railroad went bankrupt. And what happened? Well, their bankruptcy cost was estimated to be around, say, 2% of the firm. What are some other characteristics? Okay, how about firm size? Okay, on a percentage basis. Okay, so if we take the dollar of the bankruptcy costs divided by dollar firm value. Okay, so on this basis, do you think that when the firm size is large, that the percentage of bankruptcy costs is going to be higher or lower? Well, it's actually going to be lower, right? Because, even though this guy goes up, the larger the firm is, are there going to be certain amount of fixed costs? For example, might there just be one courtroom involved? Probably, though. It's probably right. So basically, the larger the firm on a percentage basis, the smaller the bankruptcy costs. What about how complex a firm's capital structure is? And what do I mean by complex? Well, what about private debt versus public debt? What do you think I mean by those two? Well, private debt would be where a company goes to a bank and they say, hey, we want to borrow some money. Okay, so there's basically one entity that's lending the money. Public debt is when a company issues a bond and it's public, and so now there could be anybody who invests in it. That now there could be millions of lenders. Of those two, which is more complex, where you have millions of lenders or just one lender, like the bank? Millions of lenders, right? And so under what circumstance do you think bankruptcy costs are going to be higher, when you have millions of lenders or just one lender? Basically millions of lenders. And so that's another characteristic of firm types or capital structure and bankruptcy costs. So now we've had a discussion of what bankruptcy is. It's a process. We've talked about what bankruptcy costs are. We've talked a little bit about firm type and how bankruptcy costs go up and down. So here's my question to you. Okay, why is this whole notion of bankruptcy even relevant to the capital structure decision? I mean, remember what the capital structure decision is, right? I mean, the capital structure decision is, given that we're going to raise a certain amount of money, okay, are we going to have 40% debt and 60% equity, or are we going to have no debt and all equity, and so on and so forth? So given that, why is bankruptcy relevant? Well, what if we had no debt? Would bankruptcy be more likely or less likely? Be less likely, right? And what if we had 90% debt? Would it be more likely or less likely? Be more likely, right? Because there'd be more interest to pay, and maybe the firm doesn't do very well, and so maybe they don't have enough money to pay it. So basically, the higher the debt levels, the higher the probability of bankruptcy. So here's my question. When a company is making a decision today about their capital structure, to the extent that bankruptcy is even relevant, do they make it based upon the actual bankruptcy costs if they went bankrupt in the end, or the expected bankruptcy costs? And remember, expected bankruptcy costs is the probability of bankruptcy multiplied by the actual bankruptcy costs if they went bankrupt. So a firm is healthy today, and it's making its capital structure choices today, but do they make it on expected bankruptcy costs or actual bankruptcy costs? Well, presumably expected, right? Because let's say bankruptcy costs were really big. Say, $100 million, if that's really big. Okay? But if the probability of that firm going bankrupt, I'll be extreme about it, if the probability of that firm going bankrupt was 0, then is bankruptcy even an issue? It's not, right? So basically, if bankruptcy is a key factor when it comes to a firm making its capital structure choices, not only would they be concerned with the actual bankruptcy costs, which we've been talking about if they went bankrupt, but also the probability of bankruptcy. So let's discuss these one at a time. What kind of firm would have a higher probability of bankruptcy? A high-risk firm, like say Delta, sometimes they make a ton of money, sometimes they lose a ton of money, or a low-risk, mature and stable firm, like some would argue IBM is that way, who consistently make profits. Well, presumably the high-risk firm, right? Because Delta, sometimes it's happy face and they make a ton of money, and sometimes it's sad face and they lose a ton of money. But if they lose a ton of money, maybe there's the financial crisis or there's a recession going on, and they keep losing a ton of money over a longer period of time than they can afford. Eventually, they're more likely or less likely to not be able to make those interest payments. Less likely, right? And then they could be forced into bankruptcy. So basically, a high-risk firm would have a higher probability of bankruptcy. Now, what about bankruptcy costs? Okay, what kind of firm is going to have higher bankruptcy costs? One whose value is primarily related to tangible assets, or one whose value is primarily related to the present value of all those future growth opportunities? Well, the higher bankruptcy costs would be the ones, as we discussed earlier, with the present, higher present value of all those future growth opportunities, right? And low intangible assets. Because remember, bankruptcy is a what? It's a process, right? It's a process of A, figuring out, well, what is the value? And B, how do we allocate that value once we've figured it out? And is that process easier for a hotel, which is tangible assets, or for a consulting firm, which is the present value of growth opportunities? It's easier for a hotel firm, right? So if we put all this together, okay, expected bankruptcy costs, a function of probability and the actual bankruptcy costs. If we look at the probability, it's a higher probability of going bankrupt for a high-risk firm versus a mature, stable firm. So that's why we've got the H and L for high and low. If we look at cost, one whose value is primarily dependent upon tangible assets, like the hotel, hey, we just sell the hotel, so it has low bankruptcy costs. But one whose value is primarily dependent upon the present value of all future growth opportunities, like, say, a McKinsey consulting company, would have high bankruptcy costs. So given that, what kind of firm would be wiser to have lower debt levels? The high-risk firm and the high-growth options where they have a high probability and a high cost of bankruptcy, would it be wiser for them to have high debt levels, which would make bankruptcy more likely, or low debt levels, which would make bankruptcy less likely? Well, it'd be wiser of them to have less debt, right? So if we put it all together, if I sort of, and I've made this type A and type B up, by the way, but if I call the firm value spectrum, type A firm, tangible assets, low growth options, low risk, mature, stable, and then kind of the opposite here, and you got to be careful because are these mutually exclusive? In other words, is it possible to have a high risk firm that has a lot of tangible assets? It is, right? In fact, Delta Airlines is an example. You could argue that's a high-risk firm, but are its planes tangible assets? They are, right? So when we think about this firm value spectrum, as I go through it in future examples, you got to use judgment as you apply it. In any case, these guys right here, okay, with the tangible assets, are they going to have high bankruptcy costs or low bankruptcy costs? Low, right? And if they're low risk, do they have a high or low probability of bankruptcy? Low, right? So if we put it all together, okay, type A firms are going to have low bankruptcy costs, low probability of bankruptcy. Type B firms the opposite. And so what kind of company can afford more debt? Or what kind of company would say, no, if bankruptcy is key on our mind when we make these decisions, we don't want more debt. Okay, so basically these guys, they would say, no, I don't think so. I don't think we want more debt. And by the way, consistent with our tax story, what kind of firm will more likely realize the corporate debt tax shield? These guys right here, right? So basically, the corporate debt tax shield would predict more debt because they can realize it, and also which would be a low risk firm, mature, stable, and also all of these guys would predict more debt. Okay. However, we saw with the bankruptcy, we saw with the tax story that it did or did not look like firms are thinking, well, gosh, look at all the taxes I can save. Did that or did that not seem to be the primary driver of the capital structure decision? It was not, right? And what about here? What would you think? Okay, I mean we've got some theories that suggest, all right, well, these kind of firms are more likely to have more debt than these kind of firms. Okay, but what do you think? Do you think that, say, when Home Depot is putting its business plan together, and even where Home Depot is today, do you think they're thinking, well, gosh, we better change this to 20 and 80. Okay, so we better have less debt Do you think they're thinking, just in case we go bankrupt? Do you really think that's their thought process? It's probably not, right? And maybe that'll become more apparent as we proceed with future opportunity, with future parts of this lecture. In any case, before we leave bankruptcy, okay, who pays for expected bankruptcy costs? Shareholders or debt holders? Well, debt holders, when they say, yeah, we'll lend you money and this is the interest rate that we require, given your risk, are debt holders smart enough to know about the possibility of bankruptcy? They are, right? And if they are, would they not incorporate that in their interest rate? They would, right? And if they incorporated that in their interest rate, ceteris paribus, which means all else being equal, then are the shareholders going to get more money or less money? Less money, right? Therefore, who pays? The shareholders, right? So why? Well, as I mentioned, when the firm issues debt, the debt holders, they're going to incorporate this, so they'll require a higher return, which will include a higher risk of bankruptcy. So let's go on to another assumption that we made. Remember with the Miller and Modigliani stuff, essentially they said, well, perfect market conditions, and also no matter what, doesn't matter how I raise money, I will still invest in my lemonade stand. In other words, one of the assumptions was that the asset investment decision was fixed. Okay? But what about this? What if the capital structure choices that a firm makes today has an impact on this asset investment decision down the road, say, or even now? In other words, what if this impacted that? Okay? In other words, what if it violated that assumption that, hey, no matter what, I'm going to invest in my lemonade stand? So there's a couple things I'm going to talk about in this area. And the first one is financial distress. Okay? So what is financial distress? Well, basically, the difference between financial distress and bankruptcy is, as we've already seen, bankruptcy is a process, and it begins with Chapter 11, okay? But financial distress is when the firm is not yet bankrupt, but it's worried about bankruptcy. So it's starting to take actions to avoid bankruptcy. And when it starts to take actions to avoid bankruptcy, some of these actions can have an impact, in fact, a negative impact on the asset investment decision. Okay? And there's two types that I'm going to talk about. One's called overinvestment and one's called underinvestment. Now, what do you think overinvestment is? Well, is there too much asset investment stuff going on or too little? Probably too much, right? And if it's but that's not all. There's another thing. If it's too much from a perspective that it's a bad thing, then would that be consistent with taking on positive net present value investments or negative net present value investments? Negative, right? And by the way, if you're not sure what I mean by net present value, if you go to the corporate finance series under the asset investment lecture, that I talk about that there. But in any case, overinvestment is when managers deliberately, that they know, hey, this is negative NPV, which ceteris paribus increases or decreases firm value. It decreases it, right? So they're aware of this, that they deliberately take on negative NPV asset investment decisions. It'd be like me investing in my lemonade stand and knowing that the day I buy it, that I expect, not guarantee, but I expect it to lose money. So why would a firm in financial distress deliberately choose to take on something that's negative NPV? Well, Let me give you an example, and I'll tell you why. But let me give you an example, or maybe I can get you to answer the question. Imagine that you have. Imagine you live in Vegas, okay, and you have $500 left, and rent is due in the next day, but the rent is say $1,500, and so you don't have enough to pay the rent, and so you're going to get kicked out if you can't pay the rent. What might you be tempted to do with that $500? Well, you might be tempted to gamble it, right? Because if you gamble, and first of all, when you gamble in Vegas, is that positive or negative NPV? It's negative, right? Anybody who goes to Vegas and gambles can expect to lose. Otherwise, they wouldn't have huge, giant casinos. There wouldn't be a way for companies to make money. In other words, the house is expected to win. That's just the way it is. So you might get lucky and win, and you might get unlucky and lose, but you expect on average to lose. But you might be tempted to take your $500 and gamble, even though you expect to lose. So therefore, even though it's a negative NPV, because you might get lucky and win, right? And if you get lucky and win, might you be able to pay your rent? You might, right? But what if you lost? Well, if you lost, you'd be getting kicked out of your apartment anyway, the next day, right? And so it's the same concept here, okay? Although negative NPV, the firm that's worried about bankruptcy says, you know what, we're going to take on this really high-risk thing because we might get lucky. And if the gamble failed, we'd be heading for bankruptcy anyway. You want a real-life example? This guy, Fred Smith, who was the founder of Federal Express, he is alleged, I don't know if this happened for real or not, you can look it up or whatever, but he is alleged to have taken $20,000 of corporate funds to Vegas when Federal Express was near bankruptcy. In other words, they were in financial distress. Well, he got lucky, and Federal Express survived. But what if he had gotten unlucky? Who would have essentially been left holding the bag? The stockholders or the equity or the debt holders? Basically, the debt holders, right? They would have, the stockholders, they were going bankrupt anyway. Okay, if he'd done nothing. At least that's the premise of this example. So the bank simply would have received $20,000 less. Now, would this have been rational or irrational behavior for Fred Smith to do this if the firm had not been in financial distress? It would have been irrational, right? So in other words, it's really important to note that in this example, this is happening because the firm is in financial distress. Now, by the way, is this a case of the financing decision driving the asset investment decision, or the other way around? And what's more appropriate? Well, maybe the next slide makes this question more clear. Okay? So here we have two situations. Okay? Let's say this is my lemonade stand, or let's say this is Delta, or whatever it is. Okay? Here's my business. Okay? Should I be making capital structure choices today based on the business I'm in? Is that ideal? Or even for that matter, the direction or my strategic vision for my business? Okay? Or should it be because of the capital structure choices I've made, then that's going to drive whatever my business is, or whatever the type of company I am? What do you think is more appropriate? I mean, in this case, if we take the Fred Smith example, okay, because of capital structure choices that they'd made, and then this guy did poorly, right? Presumably their business did not do as well as expected, and so now they're worried about not paying the debt holders, and so he was forced to take $20,000 and go to Vegas. Now, is that good or bad? That's bad, right? Presumably, would you prefer that they'd made better capital structure choices? Maybe no debt. Would you prefer that? Yeah, because if they'd had no debt, would have been more likely or less likely that he would have had to have deliberately engaged in negative NPV? Less likely, right? And so what makes much more sense is that a firm looks at the kind of business it is, including the strategic direction of the firm. So are we high risk or are we low risk? Okay. And given that, then they say, well, what kind of capital structure makes sense for us? As opposed to, oh gosh, we're stuck with these bad capital structure choices. Maybe we've loaded up on all this debt. Now our hands are tied and we're having to sell the crown jewels. For example, maybe Borders, when it was in financial distress, maybe it had to sell some of its top selling stores, okay, because its hands were tied with poor capital structure choices. So in any case, that's overinvestment. What about underinvestment? Overinvestment, remember, was deliberately taking on negative NPV stuff. What do you think underinvestment is? Underinvestment is basically, you know what? We know we've got this positive NPV stuff, and we should do it, but because of our capital structure choices, we're not going to do it. In other words, they're letting this opportunity go. So, for example, maybe a debt payment is coming due, and they forego R&D expenses, even though the R&D is positive. I mean, let me give you an example. Okay, imagine that you're designing software, okay, and you've got this killer app, and you feel really positive about it. I mean, this is clearly positive NPV. So you've got software engineers helping you, and maybe designers or whatever, okay, and it's positive NPV. Does positive NPV guarantee that you're going to make money down the road? It doesn't, right? It's just that you have an expectation of doing better than you expect on a risk-adjusted basis. Okay, so positive NPV. So would it make sense to start laying off your software engineers and laying off other people? I mean, would you want to do that? You wouldn't, right? But you might be forced to do that because you loaded up on too much debt. And if that were the case, again, would that be a case of poor choices on this side, driving decisions on this side? It would, right? Which is good or bad? It's bad, right? You want it the other way around. Step one, what business are we in? Are we high risk, low risk? Are we moving in a higher risk direction or a lower risk direction? And given that, then make capital structure choices that are not going to tie your hands down the road or not expected to tie your hands down the road. So if we go to this situation again, well, hey, we've got debt payments coming up, or anytime you have debt payments coming up and a firm is in financial distress, well, why not just issue new equity? Hey, we're in trouble. Let's just issue a little bit more equity. So why not do that? Well, what if a firm borrowed, say, $100? So the book value of debt was 100. Now, if it's in financial distress, as far as what that debt could trade for, would it still be $100 or would it be less than $100? Be less than 100, right? So, for example, if somebody owed me $100, but the chances that I was going to get paid was not very high, could I turn around and give you a piece of paper saying, hey, why don't you hold the loan for $100 and just pay me? I couldn't, right? And so let's say the market value of the debt was 95. Okay, so we have book value of the debt is 100, but because the firm is in financial distress, let's say the market value is 95. So now the firm says, gosh, we're in financial distress. Let's raise $20 more in equity. Okay. So you go to the equity holders, hey, we need $20 more in equity. Well, where will the first $5 of that equity go to? It'll go to the debt holders, right? Because they get paid first. And would equity holders be willing to say, all right, we'll give you 20, and we know of that 20 that that 5 is going to have to go to the debt holders because of the bad decisions that you made previously, and then the other 15 can go towards, good stuff, hopefully. Okay, so would equity holders be willing to do that, where the first $5 goes to making up bad decisions? They wouldn't, right? And so basically, once a firm is in financial distress, it's too late to rearrange your capital structure choices. So in this example, if the firm had maybe made better capital structure choices, would they have been more likely or less likely to turn down that R&D investment if they'd been all equity? Been less likely to turn it down, right? So here's a major point. Okay, we've just gone through two situations. Firm is in financial distress, and in one case it said, you know what, we're going to gamble, we're going to invest in negative NPV, which is a good or a bad thing? It's a bad thing, right? I mean, or at least you wouldn't want the firm to be in that situation. And another situation where a firm says, you know what, because we're in financial distress, we're going to have to lay off these software engineers, because even though it's a great positive NPV thing. What kind of firm do you think loses more value when it deviates from making good asset investment decisions? A firm whose value primarily depends upon the present value of all future growth opportunities, or a firm whose value primarily lies in tangible assets? Well, basically, the growth opportunities, right? I mean, an example that's not too bad is Netscape. Okay, Netscape went public in 1995, and I may have my numbers wrong here a little bit, but basically, in 3 minutes when they went public, they created something like $3 billion worth of value. That was more than Sears in the previous 6 decades, and that could be an incorrect statement, but I remember hearing something along those sort of lines. So you'll have to check my facts on that. But you get the point, right? And yet, just a few months prior, in the December time period, they were worried about forthcoming obligations, and they were looking at actually laying people off. And this guy, I think his name was Jim Clark, he said, no, we're going full speed ahead. This ship is going to sail or it's going to sink. But in any case, it's an example where if they had been worried about forthcoming debt and financial distress and so on and so forth, all that value, all the present value of those future growth opportunities, that would have just gone down the drain. And so that would suggest that a firm whose value primarily depends upon the present value of future growth opportunities, okay, the ceteris paribus, it would make sense for them to have more debt or less debt. Less debt, right? Now you got to be careful about the way I'm putting this. Okay, I'm kind of tying risk into it also. Okay, if you could, of course, have growth opportunities without any risk, if somehow that if the risk was zero, okay, you could make an argument for more debt, because then the shareholders could could benefit from all of the gains, right? But assuming it's reasonable to suggest that growth is tied into risk, in other words, financial distress is a possibility, then the last thing you want is for your hands to be tied because of poor capital structure choices today. In other words, loading on with too much debt and then having to shut things down before, for example, in Netscape's example, they go public and within 3 minutes they've got about $3 billion in market capitalization. So basically, this seems to be the key. Okay, the kind of firm you are and the asset investment decision, not having your hands tied, that seems to be a primary driver in the capital structure choice. In other words, companies will say, hey, what kind of firm are we? Okay, are we a high risk firm? Are we a low risk firm? And what kind of capital structure choice makes sense given the kind of company we are and the direction that we're heading in? And so evidence supports that firms whose value primarily lies in growth opportunities will typically issue less debt. By the way, bond covenants, which are essentially promises, part in the contract, are written to restrict some of these practices that I've talked about. And by the way, is that good or bad for shareholders? It's good, right? Because does it make the cost of debt more costly or less costly? Less costly. All right, so another thing I want to talk about that relates again to this assumption about, hey, no matter what, I'm going to invest in my lemonade stand, is this notion of free cash flow. Now, what is free cash flow? Well, it's a definition, right? Either you know it or you don't. I'm not giving you the accounting definition right now. I'm going to give you the finance definition. And that is that a firm will have a certain amount of cash and it'll need it to pay its debt holders and all its obligations. It'll need it for future, for existing asset investment decisions, etc. And once it's used all of that money, any cash that has left over, okay, that it's used for positive NPV investments, is what's known as free cash flow. And so therefore, by definition, if it's already exhausted all of its positive NPV asset investment opportunities, and it still has cash flow left over, then the cash left over must be for what? What kind of NPV? Zero or negative, right? And so for a firm that doesn't have a lot of growth opportunities, would shareholders rather the firm say, all right, well, we've got all this extra cash, and I'm not talking about just because a firm has any cash. Could it be positive NPV for a firm to have a certain amount of cash just on the balance sheet sitting there? It could, right? I mean, that's a whole nother course. That's working capital. But I'm talking about what's perceived as way too much cash. If you've got way too much cash, is it tempting maybe for the firm to buy a fleet of aircraft that it doesn't really need? Or to take extravagant, lavish trips, the whole family invited, on conferences, and that, it's negative NPV stuff. Because when negative NPV stuff happens, in theory, what happens to the stock prices? Go up or go down? It goes down, right? So what would the shareholders prefer? Would it prefer, by definition, that a firm has more free cash flow or less free cash flow? Less free cash flow, right? And what is a way for a firm without a lot of growth opportunities to reduce its free cash flow? Well, what if it had more debt? If it had more debt, would it pay more interest? It would, right? And if it paid more interest, would it have more free cash flow or less free cash flow? Less, right? And would the shareholders prefer that? Would they prefer that cash be used to pay for interest to debt holders? Or would they prefer cash be spent on negative NPV stuff? They'd prefer more debt, right? And so therefore, a benefit of debt is for mature firms with few growth options and low risk is basically just to reduce their free cash flow. So if we put it all together, basically when it comes to financial distress, debt has high financial distress costs for firms whose value primarily depends upon these growth opportunities. And when it comes to free cash flow, debt can reduce the free cash flow for firms that are low risk and without a lot of growth opportunities. And so this is a big deal. If you look at companies and you look at the firm, the type of firm spectrum, a lot of capital structure choices can be explained by not only the kind of firm it is, but the direction that it's heading in. By the way, would a firm make its capital structure decisions today based on where it is right now, the type of firm it is right now, or the type of firm that it is looking to become, but particularly if it's moving in a risk-increasing direction? So, for example, imagine, say, Barnes & Noble. I'm just going to make this up, okay? So let's say they decide, you know what, and Barnes & Noble is a bookstore, and they decide, you know what, I think what we're going to do is we're going to put more and more of emphasis on electronic stuff, like the Nook and e-readers and so on and so forth. And that's our vision. And less emphasis, we're going to rely less on the traditional bookstores that we have spread across the country. Would you say that's a risk increasing or risk decreasing direction? Or would you say the whole e-industry is becoming more competitive or less competitive? Well, it's a matter of opinion, but probably more competitive. And so imagine they're moving in a risk increasing. Maybe they also say, you know what, I think we're going to start opening up bookstores abroad. Okay, would that be risk increasing? It would, right? So given that, should a firm make its capital structure choices today based upon the direction it's going in? Imagine it's going in a risk increasing, or just where it is today? Well, presumably the direction it's heading in, right? Make your capital structure choices today dependent upon the direction it's heading in, because what if they say, all right, well, given where we are today, we can have this much debt, 40 debt and 60 in equity. And then they move in a higher risk direction and things go badly. And they go, okay, gosh, we better issue some more equity and buy back some debt. Now, might it be too late? Yeah, it might be too late, right? They might already be in financial distress. Once you're in your financial distress, is it too late to issue equity? It is, right? I mean, the equity holders are going to go, no, I don't think so, because part of my money is going to go towards the debt holders. And so basically, when a firm is making its capital structure decisions, particularly if it's moving in a risk increasing direction, it needs to not only consider the kind of company it is today, but the kind of company it is intending to become. So far what we've done is we've looked at debt levels at a point in time. Under the heading of capital structure information asymmetry, what I want to do is look at, well, what about capital structure changes? Okay, what about changes in capital structure? Now, if you recall, no information asymmetry was one of the perfect market assumptions. What does that mean again? No information asymmetry. Well, asymmetry means without symmetry. So that basically means I know as much about IBM as, say, the CEO of IBM. In any case, these theories, signaling and the pecking order theory, are about changes in capital structure. So let me ask you this. Information asymmetry. All else being equal, when it comes to the true value of the firm, Is it better that the market does or does not have the true value of the firm? So I'm not talking in general about information asymmetry. So for example, it's hard for me to believe this is true, but say the Coke formula, right? That syrup that they make, apparently, that's supposed to be secret. And so is it good or bad for Coke shareholders that is secret, if it is really secret? It's good, right? Because Coke can use that as the sole entity that has this syrup and make Coke and sell Coke, right? But when it comes to information asymmetry about the true value of the firm, is the company better off if the market has the same sense of what the value of the firm is as the insiders, or with inside information? Well, it's better not to have that information asymmetry, right, from that perspective. And I'll tell you what. Let's talk about my car, okay? I have a Honda. It's not very new. It's an '05, I think. And I imagine I drove it to class today, okay? And so it works. And I tell you, all right, I've done all the oil changes and I've done all the maintenance, and based upon what I know, let's say I know that it's worth $5,000, okay? But do you know that I necessarily did all that stuff? Is there proof that I did all the oil changes and I've broken the engine nicely and I've taken good... Is there proof of that? There isn't, right? And so therefore there's an information asymmetry between the true value of the firm, given full information of the car, given full information with what I know. But for me to, and what you know. Now for me to sell it to you though, because you don't know what I know, what do I have to do to the value of the car to bribe you into being willing to buy it? I have to lower it, right? So instead of $5,000, maybe I'm able to sell it to you for $4,000. And so basically, from that perspective, you could argue that information asymmetry, all else being equal, when it comes to the value of the firm, is bad for the shareholders. So with that in mind, let's look at signaling, the signaling theory, okay? So management knows more about the value of the assets or the firm than the market, okay? That's point number one. So there is information asymmetry. Now, if they borrow a bunch of money, what kind of signal can this convey to the market? Okay, if you think about this, right, you've got assets, right, and you hope that assets will produce what? You hope they'll produce sales, right? So if that's my lemonade stand, you hope that they'll produce a certain amount of sales. But then you've got to pay for lemonade, and you've got to pay for my kids to sell the lemonade, et cetera, et cetera. And if you have a bunch of debt, then you also have to pay what? Interest, right? And so if management says, you know what, we're going to go from just $40 in debt to $60 in debt and buy back equity, okay, so we're not changing the assets, we're just changing the capital structure, then does that suggest they have more confidence in their ability to manage the assets and produce the sales that needed, or less confidence? More confidence, right? So basically it produces a positive signal. Now, why is the signal credible? Well, what if the assets did not produce as management expected? And therefore, what if they couldn't make the interest payments? Would management more likely or less likely keep their jobs? Well, they'd less likely keep their jobs, right? In fact, there's plenty of research out there that shows the increase in the percentage of top management that loses their jobs shortly after a bankruptcy. So basically, that's an example of the impact of a change in capital structure on firm value and its role. But while there's some empirical evidence that supports this theory, so hey, issue a bunch of debt and buy back equity so we have confidence that we can make these interest payments, there is the actual amount that the stock price goes up based upon that signal is relatively minor. Okay. So let's look at another theory, the pecking order theory. Okay. Imagine that managers know more about their firm than the outsiders. So we have this information asymmetry. And let's say the managers say, you know what? Our stock is trading at $55 a share. It really, based on our information, should only be trading at 50. So it's overpriced. Now, would that be an incentive for them to issue stock? It would, right? It'd be like, hey, gosh, it's trading at 55, but we think it's worth 50. We should issue more stock. That's a good deal, right? And so, question is, well, do you think the market could figure this out? Do you think the market's smart enough to know about this thought process that, hey, issue equity, it's overpriced. So obviously, they're basically conveying that it's overpriced. And so if that's true, then how would you expect the stock price to react when management announces they're going to issue equity? Well, presumably, it'd go downwards, right, based on that thought process. Now, would the same logic apply to debt? It would, right? So the same logic would apply to equity, it would apply to debt, but based upon the announcement, which one do you think would go down more? So when management says, hey, we're going to issue a bunch of equity, and so the stock price drops based upon the announcement, or we're going to issue a bunch of bonds, so the bond price drops based upon the announcement. Which one do you think would drop more? Well, probably the equity, right? Because they're the last ones to receive any kind of capital. With the debt, they're locked in unless there's probability of default or whatever. But which has more fluctuation, equity or bond prices? Equity, right? Because they're the last folks to receive any kind of cash. Bondholders, they get their interest payments and so on and so forth, and whatever is left over belongs to the equity holders. So they're a lot more subject to, was the asset investment decision more successful than expected or less successful than expected, and so on and so forth. And so given that, if a company did want to issue more capital and it's worried about this announcement impact, would it make sense to issue debt, all else being equal, or issue equity? Issue debt, right? Because debt wouldn't drop as much in value as equity based upon this theory. But what if they didn't even go to the capital markets at all? What is another way that the firm, in a sense, creates capital, but they don't have to go to the capital markets to get it? Well, they can earn it, right? Because if we go through all of this again, okay, so the lemonade stand produces sales, and you've got costs, etc. In the end, you're left with net income. And if the company keeps all that net income, who does that belong to? That belongs to the equity holders, right? Or the shareholders. And when a company keeps all its net income, then what do they call it? Retained earnings, right? So the pecking order theory says, all right, well, if we need capital, best choice is retained earnings because there's no market reaction to that. Then, if we're going to issue something, let's issue debt because that won't react as negatively. And then the last thing we'll issue is equity. And while this is a theory, there's not a lot of empirical evidence that supports that this is the thought process that companies go through. All right, so what I want to do now is go through some other capital structure issues, in particular long-term debt versus short-term debt and private versus public debt. So let's start off with long-term versus short-term debt. So imagine this is the firm value spectrum again. Okay, so those are the two types of firms. And my question is, well, for what kind of firm would long-term debt be more expensive? So what I'm talking about here is, all right, imagine a firm has $500 in debt, but maybe the choice we're thinking of is, well, do we want $500 in debt that only has 1 year maturity or say 20 years maturity. Okay, so the 500 is given. Okay, but for what kind of firm is long-term debt more expensive? What do you think, type A or type B? Well, basically type B. Okay, well, why? Okay, well, number one, do these guys have collateral? They don't, right? And they're also higher risk. So why would higher risk make long-term as opposed to short-term increasingly expensive? Well, let's say they do really well, okay, because they're high risk. So if you're high risk, is it true you either do really well or really poorly? It is, right? So if they do really well and pay the money back early to the bank, does the bank like that or dislike that? They don't like that, right? The bank would, as long as a firm is going to pay what it owes, the bank would love to keep earning interest. So the bank basically faces refinancing risk. And if they do poorly, then are there potential underinvestment problems? There are, right? And so basically what we see is that the type B firm, the higher risk firm, they have a steeper term structure. And so therefore, if they're going to have any debt, short-term debt makes more sense for them. Now, can you think of any other reasons why a type B firm, if they're going to have any debt, is better off with short-term debt? Well, what about the underinvestment problem, right? If we have something like this, okay, imagine we have short-term debt, and then we have the asset investment opportunity, okay? Or we have the asset investment opportunity, maybe this is hiring more software engineers or whatever, but then we have debt that's due. So here's the long-term debt. Well, if the company is worried about paying off this debt, might they say, hey, we better not hire these software engineers? They might. Would that be a good thing or a bad thing if this was positive NPV? It'd be a bad thing, right? So basically, if type B firm is going to have debt, ceteris paribus, short-term debt is less likely to lead to this underinvestment problem issue. So what about private versus public debt? What kind of firm do you think will choose a less complex capital structure? And just to remind you, a simple capital structure is what? Well, for example, if you borrow money, maybe you borrow it from a bank. That would be private debt. So there's just only one lender. Complex would be public debt. Go to the bond market and issue bonds, and now you've got hundreds of thousands of potential lenders, any investor, right? Now, if a firm gets into financial distress, point number one is, what kind of firm has more to lose when it gets into financial distress? One whose value depends upon all the future growth opportunities, like, say, Netscape, or one whose value is dependent upon tangible assets? Well, more to lose is the present value of all growth opportunities, right? Because if they end up going bankrupt, that's not going to happen. So basically, the type P firm has more to lose if they go bankrupt. And so the question is, well, imagine they're in financial distress. Is it easier for them to renegotiate their debt if it's if it's just one bank they go to, i.e. private debt? And is it easier to renegotiate that, or is it easier when it's more complex? Basically, it's easier if it's simple, right? And so basically, since these guys have more to lose if they're in financial distress, and since renegotiation is easier with private debt, then to the extent that these guys do have debt, type B firms, then they'll have private debt. Okay, so what I want to do now is just summarize all three capital structure lectures and summarize perfect markets, taxes, bankruptcy, etc., etc. And then I'll end up with that real-world example that I mentioned right at the beginning of this lecture, and that is where we went to this Fortune 100 company and we got a treasurer's perspective. So, perfect markets. Basically, Miller and Modigliani made two sets of assumptions. Remember what those were? Well, number one, the asset investment decision is fixed. In other words, hey, no matter how I choose to have my capital structure, no matter what I do on this side, this guy's fixed. I'm still going to invest in my lemonade stand. And then they also made the perfect market assumptions. No taxes, no transaction costs, no information asymmetries. And we saw in that particular circumstance that capital structure did or did not matter. It didn't matter, right? That they showed that, hey, you know what? Doesn't matter whether it's 20% debt or 50% debt or whatever. It's not going to either impact firm value or stock price. And then we talked about taxes, right? And we basically said, all right, well, you know, there's a debt tax shield, and that has an advantage, but then you add in personal taxes, and that sort of offsets the advantage of debt. And in the end, we said it doesn't look like taxes drive the capital structure decision. Why? Because if you take a company like IBM, which has a very safe debt rating, I'm assuming, that they could afford to issue a lot more debt, or they can't afford to issue more debt. Well, they could afford to issue a lot more debt, right? But do they do that? No, they don't. Which means they are or they're not giving up some debt tax shield. They're giving up debt tax shield. And so that suggests that taxes are or are not a primary driver of the capital structure decision. That they're not, right? And then we talked about bankruptcy. Okay, we talked about different types of firm, and we basically said that if a firm were going to think about, hey, I got to think about bankruptcy when I make up my capital structure, if they were even going to think that way, then would they be thinking in terms of actual bankruptcy costs or expected bankruptcy costs? Expected, right? And so what that means is they would have to consider not only the bankruptcy cost itself, but also the probability of bankruptcy. And so what has a higher probability of bankruptcy, a high risk or a low risk firm? A high risk firm, right, has a higher probability of bankruptcy. And what has higher bankruptcy costs? One whose value is primarily based on intangible assets or present value of growth opportunities, or say tangible assets like a hotel. Well, remember that bankruptcy is a what? It's a process, right? It's a process of figuring out, well, hey, I wonder how much this company's worth, the value, and then allocating it according to parties that have a claim on those assets. And so is it easier to value a firm whose values depend upon the future or the present value of growth opportunities, or is it easier to value a hotel? It's easy to value a hotel, right? You just put it on the market and you see what people will pay for it. And so basically a company whose value is primarily based on high growth opportunities, well, they're going to have higher bankruptcy costs. So if this type of firm has both higher bankruptcy costs and a higher probability of bankruptcy, would it make sense that they would have a lot of debt or a little debt? Or no debt? Well, basically little or no debt, right? Because if they have little or no debt, are they more likely or less likely to face all this bankruptcy costs and probability of bankruptcy? Less likely, right? So basically, firms with lower bankruptcy costs, type A, will likely have more debt, and that's also consistent with the tax story. Okay, type A firms are more likely to realize the debt tax shield. But as we saw, that doesn't seem to be the primary driver of capital structure choices. And what do you think right here? Do you really think that, say, a Home Depot is thinking, well, gosh, we we better have a capital structure such that we don't have to face bankruptcy down the road. Do you really think that's their thought process? Probably not, right? So then we looked at that assumption that, hey, no matter what, I'm going to invest in my lemonade stand. So in other words, the choices I make here do not drive what I do here, right? But we saw that when a firm was in financial distress, that the choices that they made here can drive what happens here, right? So remember when we talked about Fred Smith, the CEO of Federal Express? He was worried about financial distress, and so he did something that, he allegedly did something that was negative NPV. He took $20,000 to Vegas, gambled and won, and they avoided financial distress. Okay, and we also talked about a firm's free cash flow. So basically, when it came to overinvestment, we talked about the big gamble. That's the Federal Express story. But we also talked about underinvestment. We talked about companies that may have great positive NPV stuff, like Netscape. Okay, if I have the story correct, around December they're thinking of laying people off, but then they got in Jim Clark and he said, no, that's the wrong thing to do. That's all positive NPV stuff. And then 5-6 months later or whatever, they have their IPO, and within 3 minutes you've got $3 billion worth of market capitalization. Okay, so basically the value of firms, a firm whose value is dependent upon the present value of future growth opportunities, they have a whole lot to lose if they're having to forego positive NPV stuff. And so they are more likely, these high growth, high risk firms, they're more likely to have more debt or less debt. Less debt, right? And so what we're seeing a picture emerge here in that when it comes to capital structure choices, what seems to be the primary driver of those capital structure choices? Well, what kind of company am I? And what kind of company do I want to become? Am I high risk? Am I low risk? And so on and so forth. So then we looked at free cash flow. And we said that free cash flow is what? Well, basically any cash, this is the financing definition, basically any cash that's left over after a firm has exhausted all of its positive NPV investment opportunities, which means by definition any cash left over is what kind of NPV? Zero or negative, right? And so what would the shareholders prefer? Would they prefer that the company engage in negative NPV stuff, or would they prefer they pay it out in interest to the debt holders? Well, if it's negative NPV stuff, what happens to the stock price? In theory, it goes down, right? So basically, the equity holders are saying, you know what? We would prefer that we have more debt, say 40 instead of 20, and fewer equity holders, because we'll be paying out interest to debt holders, but number one, it won't be negative NPV with free cash flow, and number two, there'll be fewer of us to share all the the good stuff that these assets produce. And so what kind of firm is more likely to have free cash flow? One with a lot of growth opportunities or one with few? One with few, right? And so basically, mature, stable firms without a lot of growth opportunities, ceteris paribus, at least from a free cash flow perspective, would debt be a benefit or a negative? Be a benefit, right? So if we put this together, costs of financial distress, they're high for type B firms, so they'll have less debt. For type A firms, they'll have more debt, so they have less free cash flow. And if we look at the real world, empirical evidence suggests that, again, type A versus type B. And let me go back a slide. Remember, I told you about judgment here, right? Is it possible to have a high-risk firm with a lot of tangible assets? It is, right? Like Delta Airlines, all their planes are tangible assets, but they're also a high-risk company. Okay, so you got to use some judgment when you look at this firm value spectrum. In any case, empirical evidence suggests that the kind of firm you are and the direction you're going in is the most important determinant when it comes to a firm thinking about its capital structure choices. And in particular, you don't want the choices that you make here tying your hands with what you want to do over here. So all that was about levels of debt. Then we talked about some theories that related to changes in capital structure. We talked about signaling and the pecking order theory. With signaling, we said, all right, assume that managers know more about the value of their firm than the market, and then they issue a whole bunch more debt. Now, if they issue a bunch more debt, are they going to owe a lot more interest? They are, right? And if they owe a lot more interest, does that mean that they got to be pretty confident that they can manage the firm such that they can make the interest payments? It does, right? And why is the signal credible? How do we know they're not just faking it? Well, the signal's credible because if they're wrong and they go bankrupt, are they more likely or less likely going to lose their job? They're more likely to lose their job, right? And so empirical evidence shows that, that this seems to hold water, this whole theory in practice, but it economically, it doesn't make a huge difference. So the stock price may go up, but not significantly based upon this particular theory. Okay, then finally we talked about pecking order theory. And basically we said, okay, well, let's say the stock price is trading at 55, but managers know, hey, it should really be trading at 50. So it's overvalued. Then would that be an incentive for them to issue new stock? It would, right? And can the market figure this out? Can the market think, oh wow, they're issuing new stock. It must be that it's trading too high. And if they can figure that out, based upon the announcement, you'd expect the stock price to react positively or negatively. Negatively, right? Now, with that negative impact, would there be more of a negative for equity or debt? More negative for equity, right? Because they're the last ones to receive any residual cash flows. Equity is much more volatile than debt, where the interest payments are fixed. And one where there's no announcement is when you don't go to the capital markets at all, and that would be through what? Through retained earnings, right? And so we have that, according to this theory, the pecking order theory, that if a firm needs capital, number one, let's get it internally, so retained earnings. Number two, debt, because even if the market thinks that debt is overpriced, it's not going to react as negatively as equity, which is why equity comes last. But there's not a lot of empirical evidence that supports this story. So what I want to do now is talk about the real world. As I mentioned, my class went and they did a presentation. This was a Fortune 100 firm on, we'll just call it ABC, what should ABC's optimal capital structure be? And so it's not that managers are thinking, well, gosh, we're worried about bankruptcy and so on and so forth, okay? But here is the logic, okay? If the business that they're in, if this is high risk, then all else being equal, do they want to exaggerate that high risk with also high financial risk? And by that I mean, a lot of debt. So by high financial risk, I mean, well, gosh, what if we cannot pay off what we owe? Or would it make sense that if you're high risk on this side, you try to have low financial risk and therefore low debt levels on that side? And basically, you would have the low debt levels on this side. And so like I said, this treasurer of this Fortune 100 company, that's basically a thought process that's consistent with, hey, what kind of business are we? Who are we? Are we high risk, low risk? And what direction are we headed in? So in any case, that wraps up the capital structure lecture. The next lecture is going to be on dividend policy. And as always, I hope this was a good learning experience for you. And hope to see you at the next lecture. Take care. Bye-bye.